Welcome to this explainer. Now, we've all heard that macroeconomic formulas dictate how governments operate, but let's be honest, staring at the raw math can sometimes completely obscure the reality on the ground. So today, we're unpacking the exact step-by-step methodology behind calculating national wealth. We are going to decode the recipe, so to speak, to see what actually drives an economy. Think about this for a second. Imagine trying to track down every single dollar, rupee, or euro earned across an entire economy in a single year. We're talking everything from the massive profits of multinational corporations down to the wages of a local factory worker, and even the rent paid on a tiny apartment. How on earth do governments actually tally all of that up without, counting the exact same money twice? It sounds literally impossible, right? Well, here is our roadmap for today to figure that out. First, decoding national income. Second, the income method explained. Third, unpacking operating surplus. Fourth, adding NFIA to the mix. Fifth, strict rules and precautions. And finally, number 6, calculating the final score. Let's start with part 1, decoding national income. Before we dive headfirst into the math, we really have to ask the obvious question, why even bother measuring this in the first place? Gathering this absolute mountain of data isn't just some dry academic exercise. It's essentially the ultimate dashboard for a country. Governments rely on these exact figures to formulate crucial economic policies and figure out their budgets, like how much they can realistically spend on defense. It gives us a clear indicator of a nation's economic progress, lets us compare our standing internationally, and helps groups like trade unions truly understand the structure of the economy. It is the absolute bedrock of real-world decision-making. Moving right along to part 2, the income method explained. So how exactly do we build this economic dashboard? The core framework here is the income approach. Now, this method is all about measurement based on factor income. And what does that actually mean? Well, it means we are tallying up the income earned by the owners of the factors of production. We're talking land, labor, capital, and entrepreneurship, whenever they contribute to the production process. The absolutely crucial point to remember here is that we only count earned income. We are looking for new value addition in the economy. We completely ignore unearned income. Things like charity or pensions, those are just transfers of existing money, not the creation of new wealth, so they don't make the cut. To calculate our domestic income, picture a giant pie made of 3 main slices. First up, the compensation of employees. This is the everyday stuff: wages, salaries, and Social Security contributions earned by workers. The second slice is the operating surplus, which is basically the income generated by the corporate and property sectors. And the third slice is mixed income. That covers self-employed folks, where it's kind of impossible to separate their personal wages from their business profits. All right, part 3. Unpacking operating surplus. Let's zoom in on that second slice of the pie, because this one often trips people up. What exactly makes up the corporate and property sector? Well, if we look at the official Central Statistical Organization definition, they describe operating surplus as the gross output of a producer's value less the sum of intermediate consumption, compensation of employees, consumption of fixed capital, and indirect taxes. I mean, wow, talk about a mouthful, right? Let's translate that into plain English. If you take a company's total sales, subtract the cost of raw materials, subtract the workers' wages, the wear and tear on the machinery, and government taxes, whatever cash you have left over at the end, that is your operating surplus. We can break the surplus down even further into 2 distinct categories. The first is income from property. If you provide land or financial capital, you earn rent, royalty, or interest. Simple enough. The second category is income from entrepreneurship. If you're the one actually running the business, you earn profits. But remember, that profit gets sliced up too into dividends paid out to shareholders, corporate tax paid to the government, and retained earnings, which is the money kept in the bank for future business growth. But what happens when you act as both the producer and the supplier at the exact same time? That brings us to mixed income. Think of a self-employed doctor, a local shopkeeper, or a farmer. Or, and this is a really interesting one, consider the imputed value of someone consuming their own goods, like a farmer eating the very wheat he grew, or Sharmaji living in a house he owns instead of renting it out to a tenant. Because they are providing the labor, the land, and the capital all at once, their income is literally a mix of wages, rent, and profit. Now for part 4, adding NFIA to the mix. Everything we've discussed up to this point, that's strictly domestic. To upgrade this to a true national calculation, we have to look beyond our borders. NFIA, or Net Factor Income from Abroad, is the vital bridge between domestic income and national income. It's actually a pretty simple comparison when you break it down. We take the factor income earned from abroad by our normal residents working outside the country, and we just subtract the factor income paid to abroad, which is the money non-residents are earning while working inside our economic territory. Specifically, there are 3 adjustments we have to make across our borders to finalize this number. First, we look at the net compensation of employees, which balances the wages of our resident workers abroad against non-residents working here. Then we look at the net income from property and entrepreneurship, balancing cross-border rents and dividends. And finally, net retained earnings, which accounts for the reserves kept by resident companies located abroad minus non-resident companies located here. Once we add this net international spice to our domestic dish, we officially have our national income. Which brings us to part 5, strict rules and precautions. Okay, before we calculate the final score, we need to talk about the rules, because if you throw the wrong data into this formula, you will completely ruin the final calculation. To make sure you never include the wrong things, there is a brilliant, sticky little mnemonic you can use as your ultimate filter. It's called the TIDFWC rule. Whenever you are looking at a piece of economic data, just run it through this filter. Let's break it down. The first half is tied. These are the things you absolutely must exclude. T is for transfer income, like old age pensions or charity. Like we said earlier, no new value is created, it's just a money merry-go-round. I is for illegal activities, like underground gambling or theft. Aside from not creating new wealth, criminals don't exactly file official tax records. D is for double counting. We exclude the sale of secondhand goods, like buying a used car, because it was already counted back in the year it was manufactured. And E is for the exchange of financial assets. Buying and selling existing shares or bonds is just trading paper ownership. You aren't producing new goods. Now for the second half, FWC. F stands for free services. Now this one you absolutely do include. This is that imputed value we talked about, like living in your own house or a farmer's self-consumption. Even though no market transaction occurred, genuine economic value was still created. W, on the other hand, is for windfall gains, like hitting a lottery jackpot. Strictly excluded. It's just a transfer payment. C is for capital gains. Say your vintage car appreciates in value over the year. Excluded. The car just got more expensive. No new car was actually produced. And finally, there's an unwritten T at the end of TIDFWC for taxes. Exclude all taxes, direct or indirect, because they are just money moving from citizens to the government. The golden rule here is if money just changes hands, keep it out. If new value is created, put it in. And finally, Section 6, calculating the final score. Now that we filtered our data perfectly, let's bring the whole thing together. You can view this as a step-by-step funnel. Step 1, we add up employee compensation, operating surplus, and mixed income. Boom, that gives us our raw domestic income. Step 2, we add our net factor income from abroad, which upgrades us to national income. But what if we want to know what actual families can spend? Well, for step 3, we take that national income and deduct income not flowing to households, like undistributed corporate profits, and then we subtract personal income taxes. What drops out the very bottom of that funnel is disposable household income. To show this math working in practice, let's say a hypothetical economy generated $715 billion in overall household income. If the government comes in and collects $310 billion in personal income tax, the resulting disposable household income, the actual money people can use to buy groceries, pay their rent, or put into savings, is exactly $405 billion. That number right there is the true spending power of the people. Which brings us to a final, somewhat provocative thought. We've spent this entire explainer meticulously tracking every single dollar earned and defining exactly what counts as new value. But does this rigid mathematical formula of national income truly capture the complete welfare and happiness of a nation? I mean, does it measure the quality of our health, the cleanliness of our environment, or the value of our free time? It's an absolutely vital dashboard for sure. But perhaps it's not the only dial we should be watching. I'll leave you to ponder that one. Thank you so much for joining me on this explainer, and keep learning.